As we head into the early hours of Wednesday, January 7th, 2026, Amazon is sitting at a price of $240.93, marking a strong 3.38% climb from the previous session. While the markets in New York are currently in the pre-market phase, the buzz around this price level is intense because it puts the company within striking distance of its all-time highs. Most people looking at their screens right now see a stock that finally broke out of a multi-month sideways grind, fueled by the general tech rally and optimism about a stronger consumer. But there is a massive gap between that surface-level enthusiasm and what is actually happening under the hood. While retail investors are cheering the move past $240, institutional desks are quietly shifting their focus towards something much more concerning: a growing backlash from third-party merchants over automated AI tools and a looming $2.5 billion settlement with the FTC. This creates a fascinating tension because the stock price is telling you everything is perfect, but the structural risks are starting to pile up in a way that most people are completely overlooking. If you've been following the narrative, the general belief is that Amazon has finally cracked the code on its cloud re-acceleration and that its logistics network is more efficient than ever. This is the common ground where most analysts stand, predicting a steady climb toward $300 by the end of the year. However, the reality is far more complex. We're seeing a significant disconnect between the capital being poured into infrastructure and the actual operating margins being reported. Amazon is planning to spend roughly $125 billion in capital expenditures this year, which is a staggering figure even for a company of this scale. The contrarian view here is that this isn't just a growth play, it is an existential defense. The company is being forced to spend at these levels just to keep its lead in the cloud space as competitors catch up, and that massive spend is starting to eat into the free cash flow that investors used to rely on. When you look at the recent trading volumes, you can see the heavy lifting being done by institutional buying, but also a subtle increase in sell-side pressure whenever the price touches that $242 resistance level. The daily price action lately has been a textbook example of high-frequency manipulation around key psychological levels. Yesterday, we saw a massive volume spike right at the open, which initially looked like a breakout, only for the price to be pinned back by large sell orders in the dark pools. This kind of activity suggests that while the broader market is bullish, some of the largest holders are using this strength to trim their positions. For instance, Archford Capital recently lowered its stake by over 7%, which might seem small, but it's a signal that the smart money is starting to question the valuation at these levels. The stock is currently trading at a price-to-earnings ratio of about 34, which is high for a company that is facing a potential recession and increasing regulatory pressure. We're also seeing a shift in how the market reacts to news. Previously, any mention of AWS growth would send the stock up 5%, but now the market is demanding more proof of how that growth translates into bottom-line profits. Let's talk about the short-selling landscape for a moment, as this is where a lot of the hidden action is taking place. Currently, the short interest for Amazon remains relatively low at less than 1% of the float, but that doesn't mean the bears aren't active. The borrow rates are stable, but we've seen a noticeable uptick in fail-to-deliver data over the last 2 weeks. This often happens when there is a high volume of naked shorting or when market makers are struggling to locate shares during periods of intense volatility. If you're looking for signals next week, keep a close eye on the days-to-cover ratio. Right now, it's sitting around 3.2 days, which means any sudden positive catalyst could trigger a minor squeeze, but the real threat to the bears is a sustained move above $250. On the flip side, if we see borrow costs start to spike, it could be an early warning that institutional shorts are moving in to hedge against a broader market correction. Retail sentiment on platforms like Reddit and X is overwhelmingly positive, with many calling for a $3 trillion market cap, but that's often when the professional shorts start looking for an entry point. Speaking of sentiment, I want to hear from you on this. Do you think the recent reports of Amazon's AI tools duplicating merchant listings without permission will lead to a massive exodus of sellers, or is the platform just too big for them to leave? Comment below with how many shares of Amazon you are currently holding and whether you're buying more at these $240 levels or waiting for a pullback. This interaction is important because the retail voice is becoming a bigger factor in how these mega-cap stocks are traded, and understanding where the diamond hands are positioned can give us a better idea of where the floor might be. To understand why the current price is so debated, we have to look back at what this business has become. It isn't just an online bookstore or a retail giant anymore. It's a massive logistics and data conglomerate. The core retail business actually operates on razor-thin margins, often acting as a loss leader to get people into the Prime ecosystem. The real profits come from AWS and the advertising business. Advertising has quietly become a massive engine for growth as the company uses its vast amounts of consumer data to offer highly targeted placements. However, this is also where the regulatory risk is highest. The FTC and various global regulators are increasingly focused on how Amazon uses its data to compete against the very merchants that use its platform. The recent lawsuit against price gouging and the AI scraping controversy are just the tips of the iceberg. If the government succeeds in forcing a structural change or a breakup of these business units, the entire valuation model for the stock would have to be rewritten. Despite these risks, the sheer scale of the operation provides a massive moat. Amazon's logistics network is now so large that it competes directly with traditional shipping companies, and its ability to deliver products within hours in major cities is a competitive advantage that is almost impossible to replicate. But even this strength has a downside. The labor costs associated with maintaining such a massive workforce are rising, and the company is facing increased unionization efforts across its fulfillment centers. This creates a ceiling on how much margin expansion we can realistically expect from the retail side. Investors are hoping that robotics and automation will eventually solve this problem, but the implementation is taking longer and costing more than the initial projections. This is a classic case of expectation versus reality. The market expects a seamless transition to a fully automated future, but the reality is a messy, expensive, and slow process of upgrading legacy infrastructure. Looking ahead, the next few months will be a major test for the stock. We have several potential catalysts on the horizon, including the upcoming earnings report and more clarity on the FTC settlement. If the company can show that AWS is not only growing but also becoming more profitable despite the massive capex, we could see a push toward $275. However, if the margins continue to compress and the regulatory noise gets louder, a retreat to the $210 or $220 range is not out of the question. The volatility we're seeing in the pre-market today is a sign that the bulls and bears are locked in a serious battle for control of the narrative. One side sees a dominant tech titan that is essential to the modern economy, while the other sees a bloated conglomerate that is overextended and facing a wall of legal and economic challenges. The short-selling data will be a key indicator to watch during this period. If we see a coordinated short attack, it will likely be timed around a negative headline or a slightly disappointing earnings metric. Retail investors can protect themselves by monitoring option open interest, particularly in the out-of-the-money puts, which can signal where the big players are placing their bets. Don't just follow the hype on social media, look at the hard data. The borrow cost spikes and the volume of off-exchange trading can tell you a lot about what is really happening behind the scenes. If you see a lot of activity in the dark pools while the public price remains stagnant, it's usually a sign of institutional accumulation or distribution that hasn't hit the tape yet. As we wrap this up, the central insight here is that while the current price of $240.93 looks like a sign of strength, it is actually a very precarious position. The expectations for Amazon are incredibly high, with the market pricing in near-perfect execution across all business units. But the reality is that the company is facing significant headwinds in the form of regulatory pressure, rising costs, and a massive investment cycle that has yet to fully pay off. We've seen how the stock has traded sideways for years in the past while the business improved, and we might be entering another one of those phases where the price doesn't reflect the internal growth. The contrast between the bullish retail narrative and the institutional cautious activity is something every investor needs to weigh carefully. The future outlook remains a tug of war. On one hand, you have the potential for a massive breakout if the AI investments start showing a clear return on investment. On the other hand, the risk of a mean reversion is real if the macroeconomic environment weakens or if the government takes a more aggressive stance on antitrust enforcement.
Always remember that the market is a forward-looking machine, and right now it is trying to figure out if the $125 billion being spent today will turn into $200 billion in profit tomorrow. It's a high-stakes gamble that will define the next few years for the company and its shareholders. Stay sharp, watch the volume, and don't let the daily swings distract you from the deeper structural shifts that are currently underway. The path to $300 is not a straight line, and there will be plenty of opportunities for both bulls and bears to make their move in the coming weeks. In summary, we started with a price that looked like a simple breakout, but quickly found that the underlying story is far more nuanced. We've looked at the massive spending, the merchant backlash, the regulatory threats, and the hidden activity in the short-selling market. The gap between what investors expect and what the data shows is wide, and that is where the most significant risks and opportunities live. Whether you are a long-term holder or a short-term trader, understanding this tension is the key to navigating the current market. Keep an eye on those borrow rates and the dark pool volumes, and always be ready to adjust your thesis as new information comes to light.